Hello, friends. In today's session of economics, we will continue with our study of the Indian economy. We have already done the profile study, population and its effect on our economy, poverty, unemployment, and inflation. In today's session, we will take up the economic reforms in our country. Since 1991, India has started a sort of economic revolution to exploit fully the country's potentials to achieve higher growth. Credible reforms have been taken place in industry, trade and infrastructure, fiscal, financial and public sectors to improve efficiency, productivity and international competitiveness of Indian industries and to impart dynamism to the overall growth process. As the initial reforms take root and second generation reforms unfold, India is emerging as one of the favorable destinations for foreign investment and a land of immense opportunity for all. India's reforms program is characterized by some very unique features. So let us go through the characteristic features of the pre-reform period first. They are quantitative licensing on trade and industry, state-regulated monopolies of utilities and trade, government control on finance and capital markets, restrictions on foreign investment and technology, import substitution and export of primary goods, central planning, discretionary process, high degree of bureaucracy, and tax concessions on exports and savings. Similarly, the characteristic features of post-reform period are abolition of industrial and trade licensing, removal of state monopolies, privatization and divestment, liberalization of financial and capital markets, liberal regime for FDI, portfolio investment, foreign technology, export promotion and export diversification, no import bias, decentralization, sound institutional framework, reforming civil services, and rationalized and being phased out. The macro adjustment policies can be broadly categorized into two groups. The first group is the stabilization policies, and the second group is the structural reforms. The stabilization policies are fiscal policies, monetary and credit policies, exchange rate adjustment, tariff policy, and wage income price policies. The structural adjustment policies are reforms in trade and external sector, reforms in industry and infrastructure, reforms in agriculture, public sector reforms, factor market reforms, land, labor and capital, etc., and administered price policy. If we take a look at the fiscal reforms in India since 1991, we will find that the basic objective of fiscal reforms since 1991 had been the reduction of fiscal deficits to sustainable levels by augmenting resources and containing expenditure, and to simplify rules and procedures for taxes and duties. The table given here shows the fiscal deficit, revenue deficit, and the primary deficit for the year 1990 to the year 2003. These three quantities are represented in the form of percentage of GDP. For example, for the financial year 1990 to 91, the fiscal deficit was 6.6% of the GDP. The revenue deficit was 3.3% of the GDP, that is the gross domestic product, and primary deficit was 2.8% of the GDP. Similarly, these quantities are also mentioned for The other financial years is mentioned in this column of the table. RE written here stands for the revised estimate, whereas BE stands for budget estimate. Please take your time to go through this table. If we compare the fiscal policies of the Government of India in June 1991 to those in December 2002, we will find that in 1991, the duty structure was irrational and the rates of both direct as well as indirect taxes were very high. Whereas in December 2002, both the direct as well as indirect taxes have been reduced and rationalized. In June 1991, the excise duties were 110%, whereas in December 2002, the excise duties were 16% CENVAT, that is Central Value Added Tax, plus 16% SCT, that is Special Excise Duty. The import duties were 400% in June 1991, which then got reduced to 30% plus 4% SCT, that is Special Additional Duty, in December 2002. The income tax in June 1991 was 54% of the income of a person, whereas in December 2002, it got reduced to 30% with 5% surcharge. The corporate taxes in June 1991 were 49% and 54% for domestic companies and 65% for foreign companies. Whereas in December 2002, corporate taxes on the domestic companies were 35% plus surcharge of 5%, and corporate tax on foreign companies were 40% plus surcharge of 5%. In June 1991, there were no service taxes, whereas in December 2002, the tax base was widened by introducing service taxes on 51 services. Also, in June 1991, there was no minimum alternate tax, written as MAT in brief, whereas in December 2002, minimum alternate tax was introduced except for the exporters. In June 1991, there was no value added tax, commonly known as VAT, whereas by December 2002, modified value added tax or MODVAT was introduced in many sectors. In June 1991, there was no maximum retail price linked excise duties or presumptive income tax or estimated income scheme for retail trades, whereas by December 2002, the concept of maximum retail price was introduced for consumption goods and other products. In June 1991, the government preempted large portion of bank reserves through CRR of 25%, that is cash reserve ratio of 25%, and SLR, that is statutory liquidity ratio of 38.5%. The bank rate of interest was 12% in June 1991, which was then reduced to 6.25% by December 2002. In June 1991, the prime lending rate or PLR was high at about 21%, whereas by December 2002, the prime lending rate was free. The present prime lending rate is 10.75% to 11.5%.